Let's connect with Mr. Bhaskar Bhat now, Managing Director of Titan. Mr. Bhat, good morning. Thank you for joining us. Jewelry business is growing, watch business margins are a problem. What should we start with?
Margins, I think margins are not the problem in the watch business. Growth is the problem. I mean, margins was a problem for a while. It's grown a little. And we had told you last time that it's a 2-year period during which correction is being undertaken in the watch division. So growth, yes, 2.4%, but that has many reasons. One of them, biggest ones being the GST. When we postponed our activation and so on. There are many reasons across industries. And the same thing held out even for jewelry. Of course, jewelry at 55% growth is really outstanding. But some of that has come in the second half of June in the expectation that gold price might rise and so on. But jewelry is continuing to grow very, very healthily.
A good one on that. Mr. Bhat, hi,
you can choose.
Let me also talk about the watches business. You know, the key question is, when is it that you're going to touch double digits? When is it that Titan watches would be in the same league as, you know, the Rados, the Raymond Wheels, etc. of the world?
Double digit what? Those brands, they don't report their profits in India in any case. Luxury brands are struggling in India. If anything, GST has had a significant impact. But be that as it may, the extremes in the watch business across the world are 2 to 3% margin with Japanese amongst Japanese brands, the big brands, and about 17-18% amongst the Swiss brands. So there is a wide fluctuation. Yes, Titan, but the double digit is already in place. It was 11% plus in watches because the impact of the VRS etc. has to be removed. However, the journey on for that is on. I have been talking about this. That's a 2-year journey. This is the second year of the journey. Cost compression, achieving growth, etc. But particularly in this quarter, activation was postponed because of the GST, because of the uncertainty of the GST. And you're aware that the GST in watches surprisingly has turned out to be at 28%, the highest in the world, which seems rather unreasonable. But that has also impacted the watch business post the GST. Of course, prices haven't moved, at least in Titan. It will have an impact on the cost because prices can't be moved up unless the competitive situation is assessed properly.
Are you saying that you're going to absorb the hit of these higher taxes and not increase prices of watches?
As of now, we have not increased only because it is not yet certain. Let me explain. I know one of the big reasons for the drop in margin is there have been excise duty benefits because of the manufacturing done in excise free zones in the north of the country, and those have begun to diminish over the years, and those have impacted margins. And to get back to those margin percentages, you would need to increase price and reduce cost. However, at the present moment, it is not at all clear how those benefits, whatever is left of them, will be plowed back into the company in the current GST regime. It is certain that it will be available, but it is not clear as to how it will be made available. Until then, we are keeping our options open. The margin impact on the trade, for example, is about 2%. So we have done a special GST kind of protection margin improvement for them so that they don't end up losing out. But a permanent change will happen only when we are very clear. So this is the current situation. A, 28% GST on watches. B, no clarity on the plowback of the benefits from these excise benefit states that we are operating in. And of course, the biggest reason is a low growth rate, and that has happened because of the activation in the last year happened in June, and this year for the Titan brand, and it has been postponed this year on account of the GST.
strategy? What is it? How is it that you're going to tackle?
Well, I think we've been talking about it quarter on quarter. In new product introduction, we have been introducing new products steadily. You will see a slew of new products in the smart category, women's smartwatches, the Fast Track, the Fast Track brand also having getting smartwatches in, and we've introduced the Reflex series in Fast Track, which has done exceptionally well. So it's a combination of new product introductions and promotions, apart from very, very carefully. You see our competitive position. Let me explain to you. We are doing our growth rates in the Helios and the large format stores is higher than our World of Titan chain. So evidently segmentation is very sharp. People are wanting to buy watches from multi-brand stores where they can compare and contrast with other brands. Again, our market share in LFS, which is the large format stores, is the highest. So these are indicators of growth coming back to Titan. However, overall the category growth is a little low at the present moment.
Your jewelry business has registered a growth of 55%. How much of that is largely because of preponement of demand, because this year festival season is actually a month early?
No, it's not because of the festival season coming early. It's because of the GST impact. We estimated about 250 crores to be the additional sale on account of the advancement of sale on account of GST. And the GST impact will remain perhaps for 15 days or so. And we have already launched an activation. So cumulative growth rates will still remain, are still in the high 40% plus.
Do you think this is
an
indication of demand making a comeback, or you're benefiting because of unorganized sector is now shifting towards organized sector?
I think it's a combination, but certainly three things are playing for us. One is post demonetization and now GST, migration is happening quite rapidly to organized sector players, particularly Tanishq. The second is our participation in the weddings segment was rather low, and with the launch of Riva and a whole set of initiatives to attract wedding, and this has been the wedding season incidentally, the growth there again has come to us from, it's a market share increase actually. And the last is the general sentiment improving. And as I said, the June number has a 250 crore additional in our estimate of the GST.
Okay. So can I safely assume that the kind of growth what you've reported in your jewelry business, at least for Q1, to imagine that kind of a growth number would be spread across for FY18 would be slightly tough?
Of course, 55% growth is not sustainable. This is an incident-led growth, but a high growth certainly is sustainable. We had indicated 15% last year and we had touched that 15%. So the 15 to 20% growth will continue, and we will achieve our targets for the year.
And just to get closing comments from you, you've diversified into eyewear, you've diversified into perfumes, you've diversified into the sari business. One would argue that you're getting into businesses which right now are small, but are you confident of scaling them up so that they can really move the needle for you? Or would you say that the eyewear business or the perfume business or the sari business is still at an incubation stage?
No. If you ask me, eyewear is no longer in the incubation stage, but the potential in eyewear is very high, very large. We will get the growth rates that we deserve back. We are the market leaders, and with 400 plus stores and an exceptional value proposition, it will, and it's a high margin business, it is expected to be higher than where it is today. But the potential for growth in eyewear is very high, because the incidence for eye correction is still very large, and the actual ownership is still very low. Perfumes on the other hand, fragrances on the other hand, is again belonging to the same space as under-penetrated, underserved in the, certainly by Indian brands, and there is the white space in which we are playing is still underserved. But it's not a very large category. So this is really a volume game multiplied by price, as in we are still penetrating, getting the habit of perfuming in this country to go on, and that's been our strategy in all our categories. Saris, yes, is in incubation stage. Perfume, fragrances and saris in incubation stage, but saris is still not even incubation, it's experiment. We just have 2 stores and we are understanding consumer perceptions to this category and our own offer. The initial indications are very, very encouraging because of the authenticity and the India under one roof story that we are offering, and the very unique retail experience. Saris, however, is a very large category, so it's a bet we are taking should we scale it up into a significant business. So you need to seed new businesses, all companies need to seed new businesses, because India is the opportunity space today across the world, as you have seen, and Indian brands serving Indians is what our story is all about. There will be some businesses which will go through periods of downturn, and margin improvement will therefore have to happen in some businesses. In other businesses, it's growth plus margin. In other businesses, it's about seeding and growing them into a certain size. But overall, every one of our businesses is profitable.
Okay, you're sounding way confident, and just a tip there on the sari business, it's always niche and affordability which is going to work with the clothing like that. But good to speak with you, Mr. Bhat, it always is, and it's always a candid chat with you. Thanks so much for taking the time out and joining in.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/etnow.